Good evening, good afternoon, and good morning to our guests from across the globe. Welcome to our digital roadshow, a quantitative approach to VC. How can it deliver big returns in half the time? I'm Lucas Lin, Head of Client Experience at Palico, the integrated digital solution for connecting PE and VC funds with quality institutional investors from around the world. It shouldn't come as a surprise to those in the investment industry that we're currently going through a challenging market environment. Amid all the sources of uncertainty confronting us today, is it time to think about an alternative approach to VC investing? An approach that uses a quantitative, model-based approach to access a broader deal flow, deploy capital faster, and get to exit sooner. Joining us today are Kirk Oliver and John Zick from EQUIAM, a San Francisco-based manager applying a highly differentiated investment strategy designed to generate top decile returns in the growth and late-stage VC space. EQUIAM performed in the top 5% of 2019 vintage VC funds. And also in less than 3 years, EQUIAM has deployed into 60-plus portfolio companies and had more than 20 exits, including companies such as Snowflake, Palantir, Airbnb, Robinhood, and Coinbase. Kirk and John, thank you both for joining us today. Great to have you on the program.
Great to be here.
Yeah, thank you. Thank you very much. We were started in 2017, really with our CEO Ziad Bakawi's realization that the private markets are becoming increasingly liquid with an entire ecosystem developing, including buyers, sellers, brokers, marketplaces, etc. He also realized that there really weren't managers focusing on this direct secondary space at the time, especially one that was able to apply a systematic or data-driven approach to the space to generate some alpha. So that was really the genesis of EQUIAM as a company. And let's get into the Q&A or the questions that you've provided, Lucas, and we can go from there.
Excellent. So the first question I want to start off with, the title we've chosen for today's discussion speaks to big returns in half the time. Now, can you put that into perspective for us and, for our listeners, what kind of numbers are we talking about here?
Yeah, thanks, Lucas. So we've been able to do, in particular with our first fund, which launched in June of 2019, in just over 3 years, or maybe just less than 3 years from that final close, we've been able to deliver a net IRR of 35.5%. That assumes a full 2 and 20 fee load. In actuality, our first fee load was a bit lower than that. We delivered MOIC of 2.45 and a DPI of 1.38. And so these are outlier statistics, especially for a fund of that age and duration. And so, what's unique about this strategy is obviously the stage of companies we're investing in, right? So we're investing in companies that are 18 to 36 months away from IPO. And this profile of company also has sort of unique exponential growth. It was identified to have sort of the unique sort of expansion capabilities and sort of the market fit that companies looking to IPO have. So our companies, we tend to, we had one M&A in our portfolio, and we've had 22 IPOs, I believe, across our Fund 1 strategy. I think obviously we're dealing with a few things that led to that. So one was the very IPO-friendly late 2020, 2021 dynamics. So we're able to really lean into that and realize some super unique exits there. Snowflake exited nearly a 6x on our entry, DoorDash exiting at a 9x on our entry, Palantir exiting at a 5x on our entry. We've been able to really lean into that market, really exiting it at some of the peak moments there. So we have sort of careful portfolio management processes and careful curation to generate these unique returns. And Fund 2 is uniquely sort of contrasting sort of time period of deployment, where we launched this fund in June of 2020, coming out of the COVID lull, right? And so we were able to really enter in some fantastic positions that really uniquely depressed valuations early in 2020. And then as 2021 progressed, we obviously saw the broader private market become more manic in nature, some valuations get extended. But what we're able to do is use our model to sort of expertly sift through that and identify those companies that still were fairly priced. Their valuations hadn't gotten stretched, and allocate into those accordingly. And so even positions we invested in Q3, Q4, many of those are actually showing mark-to-market gains as of writing today, even after the extraordinary sell-off we've seen in the public space. So I think what our model's kind of shown is the ability to target companies regardless of macro environment and identify those firms uniquely positioned for outperformance. I do think that, as we turn to Fund 3, and we'll get into this later, there's going to be times where it's a buyer's market and a seller's market. we were able to buy uniquely, strong positions in a seller's market in 2021, but now the tables have totally shifted and we're in a buyer's market. So we think we'll have the opportunity to really, really get in some extraordinary positions. And we'll talk about that in a little bit here for Fund 3. But those are some of the reasons I think that have sort of led to this. Just the profile of company we're investing in, the unique trajectory they're on, and our ability to exit those positions are really the pinnacle of the valuation in the public market.
Okay, great. And we'll certainly get to Fund 3 and some of those examples that you talked about later on. But first, can you talk through the proprietary model that you have in place? How does it work? What kind of indicators do you look at?
Yeah, absolutely. And so we've got this funnel slide here, which is sort of our recipe, so to speak, for how we go from 120,000 plus companies at the highest level of our universe to a final portfolio of 30 to 35 positions. And so as such, at the top level, we're looking at 120,000 companies, basically every firm in the U.S. that's raised a venture round since 1996. We have incorporated some international companies as appropriate, assuming we have the data, but it is a primarily U.S.-centric universe, which right now with the current geopolitical regime, I think is particularly, important with our strategy. There tend to be U.S.-based firms with, U.S.-based revenues as well. From there, we do filter these companies. So we're looking for Series B plus and 250 million plus market cap firms. This helps to ensure that these companies have robust revenue streams. They've raised, typically tier one venture funding at least 3 times, successfully. And so they're positioned for sort of near-term outperformance, just from a size and fundraising perspective. So we've kind of shifted the quality of our universe a little bit in the higher direction to a higher sort of quantile of performance. And then from there is where we run our scoring process. And so that middle blue bar kind of touches on the buckets that we're looking at when we analyze these companies. And so on the far left, we have sector health, which is a sort of unique subset of publicly traded companies that we've created. We've got about 75 proprietary sectors that we track performance, measures of momentum, valuation, among others, and compare that to the private universe. We're looking for signs of strength and weakness, which can help us to sort of preemptively see which sectors are going to be receiving, inflows of VC capital and which sectors might be seeing down rounds or more stagnant valuation growth. Company health indicators, this is one of our more important buckets. We're looking at the way companies put capital to work. So understanding, the difference between a company that, raises money and lights it on fire and the company that raises money and really uses that to generate organic growth. So really looking at, dollars in the door and their ability to generate new value. Revenue indicators, kind of in line with what I mentioned then, the value generation, but also if you're raising money, you need to be generating revenue, which kind of ties into that valuation. You also need to be growing your top line revenue and growing that revenue efficiently based on the number of heads in your business. Valuation indicators, we're looking at the way that these companies are valued in comparison to their peers, as well as their public counterparts, because many of these companies are going to be competing in public markets in the next 2 to 3 years. And so we want to be sure that these companies are positioned in a manner, growing in the way they need to be competitive on a, EV to rev multiple or, EV to EBITDA if these companies are profitable. Runway indicators. So this is hugely important at this stage in the market where we're seeing some drawdowns in private markets. We're seeing layoffs in certain companies. We need companies that have strong balance sheets. Can they withstand a potential 6 to 12 month downturn in sort of venture funding velocity or potentially valuation compression? And so that's what we're looking for. We're looking for companies that don't need to go to capital markets in 2022, but are rather positioned for, a raise in potentially a more, accommodating market in 2023. Hiring health. This is an important indicator as companies expand or contract their headcount through time. We're looking at geographic expansion as well as the type of individual they're hiring and job postings as well to see sort of their future hiring ambition. And so all of these things come together to give us a unique signal on those companies that are expanding, in the kind of current trying times and those companies that are compressing, because their businesses weren't built for a regime of this type. Moving on to the internal and external sentiment indicators. So internal obviously is looking at the sort of enjoyment of employees, working culture and whether they appreciate the CEO's efforts, among other things. Obviously it's a unique signal that needs to be paired with other financial metrics, but we find that strong financial performance companies tend to have high morale, employees, and vice versa. External sentiment indicators. So looking at, how the customers perceive their product in the broader market versus their competitors. Hugely important. We also do news sentiment analysis. We've got a data provider that provides us every news article that's released on tens of thousands of issuers, and we've created proprietary scoring rubric for those news filings. Traction indicators, looking at, website traffic, social media follows, among others. Again, this is more applicable for consumer names, but it is really important to see the uptick in those various signal verticals. Pricing momentum. So we actually have a unique data sharing agreement with Ford, one of the largest secondary brokerage platforms in the space. We see every single secondary trade that's executed on their platform, as well as all bid and ask on their platform. It's a huge advantage for us. We have unique transparency in the market, know what the general market is pricing the companies at, and then we can tactically bid around that. Typically in a market like we're in today, much beneath where we've seen recent trades close, and try to ride the momentum downwards when there's sort of unique drawdowns and take advantage of kind of the dynamics. Now, above all else, we believe the private market tends to be more fairly valued than the public market. There's less mania, there's more sophisticated buyers, and so we don't see the huge blow off tops or the incredible sell downs. So we do think that right now, with a model like ours, paired with the various signals we're looking at, we're able to identify companies that are fairly valued. And then lastly, we've got data quality, right? So we're looking at every single metric from a data quality perspective. If we don't have the requisite inputs to calculate a various signal, we're going to downshift or downweight that signal bucket. And so this is a hugely important thing for us. We want to make high conviction bet in companies we have the relevant data for. Thankfully, that's thousands of companies that meet that threshold of data quality. So we're able to really focus our efforts in that top 30 bucket. So beyond that, we've got proprietary weighting. So as I mentioned, geopolitical environments, macro environments change sometimes on a dime, and we're able to adjust our signal weights accordingly. So I mentioned the runway indicator being hugely important this time. It was also hugely important coming out of COVID. So we're looking for when times get trying and revenue might be decreasing or declining, we're going to elevate the certain weights of various signals. During more robust kind of momentum-driven periods, we can elevate the importance of our company health indicators, basically that efficiency of capital usage as companies are growing explosively. And so it allows us to be kind of accommodating to the various market regimes. From there, all of these various signals in their various buckets are multiplied together, and we come up with the final score of 0 to 1. Companies are ranked from number 1 in our universe to number X number of 1,000. And then from there, we allocate capital exclusively into companies that are ranked in the top 30 at the time of investment. And so we'll go into, I believe we'll touch on our sourcing process later in the call, but that's how we effectively arrive at our selection decisions.
Okay, great. Thank you, John, for that overview there of your model. Just a quick note to our listeners. It's come to our attention there are some listeners who might not have been able to see the slide. Don't worry, we will follow up with a replay of the presentation, and then that will include all the slides that EQUIAM is presenting as well. So no worries there. Moving on, I think with our conversation. Just in terms of, I spoke about how, between impending rate hikes, geopolitics, global supply chain issues, the lingering effects of COVID. So we're absolutely in an exceptional market environment and an exceptionally uncertain market environment. And John, can you speak a little bit more about, how your model is well equipped to kind of deal with these various sources of uncertainty that we're facing right now?
Absolutely. Yeah. I mean, I think what you're seeing is obviously a cyclicality effect right now, with people cycling out of growth more into value, commodities, things of that nature, which makes perfect sense for where we're at. There needs to be some resolutions in some of the geopolitical conflicts. Obviously, we're all aware of the Ukraine-Russia situation and kind of a chance for spiraling inflation. There's a lot of things that kind of make things extraordinarily uncertain. And I think we're seeing growth being beaten down to the point of oblivion, where I think now with a model like ours, we're able to tactically and very, uniquely target companies that have just extraordinary operating metrics. They're insulated from kind of the global sort of revenue dynamics. They've got U.S. generated income. They're growing extraordinarily fast. They're in a market that's going to be expanding over the next decade, not just the next, 18 months or whatever it may be. And so I think what's important now is to really, as I mentioned above, in that sort of previous question, is that we're really focused on the weights at this point in time, right? So we're looking at deeply in that revenue indicator, right? We need to see robust revenue generation. We need to see robust forward-looking revenue generation. We've got that data, and we're not going to be investing in a company that's seen, the revenue sort of plummet in Q1 of 2022. Obviously, that's going to deeply negatively impact them. We're also looking at that runway indicator, right? So understanding the balance sheet health of these companies compared to their peers in the private sphere. Any company that can withstand this and is 18, 24 months away from needing to raise capital is just going to be in a far better position to withstand any sort of short-term macroeconomic shock. And also, have the chance to come out on the other side in a market that lost maybe half of its competitive cohort. And so they're going to be in a position to really deliver even more value than maybe previously modeled. So those are some things we're looking at. There's obviously the elements of, sentiment indicators. So usually you're seeing sort of a dramatic downshift in sentiment. So we track the delta of sentiment as well month over month, which is really important. And again, it's all going to be compared to everything else in our model. I mean, I think that's the core of everything, right? As the general market sort of, suffers through challenges, we continue to compare and contrast. And there's going to be these rare bright spots of companies that are effectively immune to this. And we've seen it through every single macro regime. There's going to be points where, it just makes sense, regardless of what's happening in the broader market. An investment in Amazon in 1999 still is going to be an extraordinary investment. I think it's just important to do everything we can to, identify those companies. The great part about our strategy, I think, as well, which we should point on, is our secondary first approach. By deploying the secondary market, we have much more control on pricing. We're not elbowing with other VC firms to get a tiny sliver of a primary allocation. They can all fight it out, and then 6 weeks later, we can come in. We can buy anything from early pref to common stock to mid-stage pref at a substantial discount to where the round is recently priced, especially when we're having public sell-offs. And that allows us to generate a bit of additional alpha here. Now, obviously, those are sophisticated investors, but because of the bidding process, sometimes those valuations get a little bit inflated. And I think our process allows us to effectively enter in the side door with tremendous amounts of data, this holistic top-down view of the market, and bid appropriately and find people that simply need liquidity for whatever reason it may be. And so I think there's a lot of things that we do that help us to sort of mitigate or help us to, broadly take advantage of kind of changing market dynamics. Not everything's unpredictable, but we believe that our process is going to put us in position where the companies we invest in are likely to be in a great position 2 to 4 years out from today.
Okay, great. One of the things I'm sure a lot of people are curious about is, obviously with a model-driven approach, it's impossible to expect it to get every single call right. In cases where the model does get the call wrong, what processes do you have in place to kind of mitigate those losses? So do you have sort of a stop loss mechanism in place, to kind of mitigate those effects that might occur?
Yeah, absolutely. I mean, I think, there's always going to be examples and instances where, the model's going to deviate or we're going to get a bet wrong. I mean, I think, early on in Fund 1, we made a bet on WeWork, right? We came in at a 50% valuation. Turns out that should have been 95%. And so I think that led us to, important reflective work and really emphasized the iterative process of us generating new signals. That led to about 25 new signals being developed at one loss. And I think we're so focused on continually optimizing our model that I think we're in a unique position to, obviously deliver in the future and continue to increase our win rate. But, particularly on your point about, do we have a process to mitigate risks and losses? And so I think not only is our model obviously a selection algorithm, but it is a monitoring algorithm as well. We analyze the current ranking of every position in all of our equity portfolios in comparison to the broader universe. And so when we see companies dip, beneath the 150 level in our broader universe ranking, we're going to begin putting that company on notice. And so we'll analyze companies, we'll identify moments where there's some bits of weakness, where we identify there may be outsized downside risk. And in particular, if we've generated unique upside on a position, we will look to exit positions in the private market. Now, this is wholly unique for the venture space. Most venture firms, they go in, they wait 7 years and hope to God it IPOs or gets acquired. What we do is a much more active management strategy where if we see a company, especially where we realize that great return, we are absolutely willing to exit that position. Plaid's a recent example, sold 35% of our position to 5.9x return in February. We sold a position in Robinhood in March of 2021 at nearly $40 a share, fully realizing a gain on over half of our position. We've sold shares in SpaceX. We've done unique things over the years to help us mitigate unique situations within our portfolio. The other thing we're extremely excited about is the growing options market in the private sphere. So we actually participated in what we believe is one of the first call options to ever occur in the private market just this past week. We entered into a call option on OpenSea. We actually came in premium plus strike is actually beneath where the shares are trading in the open market, which is an extraordinary opportunity for us to believe it was a deeply mispriced option. We're the beneficiary of that. The unique part about this option is obviously the lower cash outlay at investment, but still with all the upside of an equity exposure. So we invest 25, 30% of the notional value of the position, but we get that long-term exposure. So we only have to exercise it if we're obviously in the money. So I think it's a really unique way for us and one that we're going to be using both on sort of speculative positions like OpenSea, as well as hedging winning positions. So we can sell calls on positions that we've got 8x, 9x returns on guarantee ourselves a 3x because of the way these option premiums are priced, and then have the upside to maybe 12 or 13x on the exit. So I think there's some really exciting things happening here, and I think that the private market portfolio management is shifting to a new level, and we want to be a leader in that space.
Great, and that's very fascinating to hear as well. About your unique approach to using options and derivatives in the private markets. Which is something we don't hear about every day. So very very interesting to hear that. And that kind of gets to my next question about how investors should think about EQUIAM strategy within their broader asset allocation. Just given how different it is from a typical VC strategy. So how should investors think about fitting this into their broader investment portfolio?
Yeah, happy to take that one. Give you a break here, John. So we're absolutely unique from a traditional VC firm, right? Our LPs know us really for our faster deployment speeds, our ability to generate high quality returns, and our faster returns of capital. We invest in the types of companies that's typical of a VC firm, but our funds more have a liquidity profile akin to, say, a public hedge fund. So we're absolutely a hybrid to the traditional VC approach, and there really should potentially be a bucket for this hybrid solution, maybe a part of your total return allocation. As John had mentioned, each of our funds are 30 to 40 positions, which makes us 3 times more diverse than a traditional VC fund. Also, from a structural standpoint, our funds are 4 years in length. That does have a +1+1 extension clause to be a max of 6 years total. But the other unique aspect of our funds are we do begin quarterly distributions after the end of year 2. So beginning Q1 of the third year for our funds, you can start to see a return of capital, which is completely unheard of in the broader VC space. Fund 1, for example, already has 138% DPI paid back to our LPs there. When you look at the benchmark for a 2019 vintage, the average is 0% DPI, right? Most VC firms are still in deployment phase. So again, very unique. We're quicker on how we deploy, and that's a function of our quantitative model. We are quicker to get returns of capital back to our investors as well.
Okay, excellent. Thank you for that, Kirk. I do want to talk specifically about the vehicle you're in the process of raising right now, which is Fund 3. Just a quick reminder for our listeners before I pose that question. So for our listeners, this is absolutely meant to be a interactive session. If you have any questions for John and Kirk, don't be shy. Feel free to type that question in the Q&A chat on the right-hand side of your screen. We want this to be as lively as we can in terms of a discussion. So I think with that said, Kirk, just talking specifically about Fund 3, could you talk a little bit about the terms of Fund 3 and also where you're standing right now in terms of the fundraising process?
Yeah, absolutely. Let me bring up a quick term sheet here for Fund 3. So we really are off to the races with Fund 3. We held our first close December 15th of last year, so about a quarter ago. We raised over $30 million for our first close, a number we were very happy about. And now, the other unique characteristic of EQUIAM funds is we do deploy capital as we raise. So we can raise all the way through the end of this year to get to our target size of 150 to 200 million. But we have already started deploying that first close capital into several positions. As John mentioned earlier, we're totally in a buyer's market. This is one of the more lucrative deployment periods we've seen since the big sell-off going into COVID. So Fund 3, we have already moved into 7 initial positions. So investors on this call, we're not just a blank open fund that you're throwing capital in, a blind pool. We do already have 7 of that targeted 30 to 40 positions already in the name or in the fund. And we can go through some of these names in more detail if there's questions on the Q&A. But we are going to have our second close here next week, continuing to do rolling closes on a quarterly basis until we get to that target size of 150 to 200 million.
All right, great. And perfect. Well, I think that covers the questions that we had prepared. Now, I do see some questions starting to come in from the audience, which is great. To our audience members, definitely encourage you to keep the questions coming. John and Kirk, I think are very eager, to hear your thoughts and questions about the EQUIAM strategy. So starting off with the first question I see in the chat. So where do you get financial information on these companies that you invest in?
Yeah, no, it's a great question. So as far as financial info goes, so we obviously have created a composite universe of hundreds of thousands, actually tens of millions of data points, secondary, tertiary data points, from providers like Privco, which has gathered revenue data on 300,000 privately held companies, some of which aren't even VC backed. And so we have sort of these unique data sources that give us the structural outline of how these firms are generating revenue. That helps us to understand sort of where these companies are from a top line perspective. We've also created sort of pro forma financial, income statements for companies within their model. This has been an effort, really, we'll call it rudimentary machine learning effort on our side, but we're looking to really contextualize how these firms operate in their space. And so we understand the cost structure. We obviously have very strong visibility into headcount, which tends to be the largest cost bucket of any sort of kind of especially capital light firm, which tends to be the type of firms we're investing in. And so we can create sort of the understanding of where these firms are from sort of an EBITDA and profit generation perspective. Obviously, though, that's just sort of the first step. And so everything we do is comparative and directional. What we're looking for is a guide us towards those companies that have the best possible score in all of those various signal buckets on an aggregate basis. And so once we get to that top 30, ultimately we get to the deal stage, we're getting data room access. At the size of the allocation we're making, we're often buying from the early founding team, super early employees, early investors. We're privy to financials, especially trailing 12 months, as well as typically getting calls with leadership of those companies. And so it's been really a huge shift, because I would say 2-3 years ago, those opportunities were few and far between, where we're getting data on maybe 20% of our transactions. Now we're getting data on 95% plus. So we're able to corroborate any number of our models with actual primary source financial data from these companies before we make a decision. In certain cases, the ranking will go up, and so then we increase the conviction. In other cases, they'll be dropped out of the top 30 because their numbers don't align with the assumptions in the model, and we'll move on from the transaction.
All right, and another question we got: so how do you access sellers? How do you access kind of the deal flow that you're getting?
Yeah, absolutely. So, Kirk, you want to take that?
Sure. So we source really in a multi-pronged approach. So John mentioned we're a secondary market first kind of firm. That's in our core DNA. That's how we got started. And so we work with the largest direct secondary marketplace here in the U.S., a firm called Forge. They do about $1 billion in transaction volume annually. We also have a unique partnership with them where we are able to get 50% discounts to anyone else on their platform, which is a huge competitive advantage from a cost standpoint for us working with Forge. You could think of our current relationship with them sort of as they're our prime broker. They've helped us source historically around 50-60% of our positions to date. But outside of our relationship with Forge, we have relationships with about 12 other brokers across the U.S. and Canada. The great part about our strategy is we have that target top 30 at any given time that we want to invest in. So we go out proactively to each of our broker relationships, go meet a handful of names to have their sales team work on and help us unlock supply. And they love working with us because they know, okay, if they find a willing seller, they already have a very professional, very institutionalized buyer on the other side, and we can move quickly and get that transaction done to get it on the books for us and for them to move on to other transactions. So broker relationships is a huge method for us to find sellers, but it's not the only one either. We also work with early stage VC firms. The common case there is they invest in pre-seed, seed, Series A. The firm's done really well for this VC firm. It's worth several $100 million on their books. We're seeing willing parties now that are willing and able to give us $5 to $7 million in supply for us to take a position. They can then return that capital back to their LPs or reinvest back in their early stage strategy. So early stage VC firms is another avenue of sourcing for us. And then we do go directly to the issuers themselves, the companies that we're interested in. And it's an easy intro. We say we're EQUIAM. We rank the entire private market universe. You've scored extremely well in our models, and we'd love to be an investor in your company. Do you, one, know anyone on your cap table who may be interested in selling and doing a secondary trade? Or two, are you raising a primary round in the near future? And if so, we'd love to participate in that way. So funds two, we did two positions were primary raises. With Fund 3 ticking up anywhere from 4 to 7 million in block size per position, I think that's also going to become a greater part of our strategy going forward to find supply in these companies.
Yeah, one point I will add is, we're seeing 300 to 500 deals a month, just from a magnitude perspective, which, is extraordinary. And so usually we'll have a hit rate of maybe 2 to 5 positions, in our top 30, amongst those 500 deals we're seeing. And so, the flow is simply extraordinary. The growth of this ecosystem is incredible. And, we've got that multi-pronged approach, as Kirk mentioned. So it's a unique time to be deploying, via strategy.
Awesome. Another question that I'm sure is top of mind for a lot of our listeners is how does the competitive landscape look like for a strategy like yours? Are you concerned that more and more other types of funds will start adopting this type of data-driven approach in the future?
Yeah, it's a great question. So I think, one of the advantages we have is just the amount of time that we've been sort of banging our heads against the wall building a systematic strategy for private markets, which at this point we're hitting around 4 years. So if someone did want to do what we wanted to do, I anticipate their ramp is going to be a similar time frame. Even if they throw, all the resources in the world at it, they first have to, attune themselves to the market, understand the dynamics of the market, create the signals that work, or create signals first, then test those signals, and then throw out the ones that clearly don't work. Because there's more failed quant investors than successful ones. And I think we're lucky to be in a position where on both a back test and realized basis, our signals are generating super unique alpha in this market. While there are other firms that are using data to some extent, most of those firms in the VC space are early stage focused. They tend to be focused on applying AI to say behavioral dynamics at early stage startups, analyzing resumes, looking at the, educational or entrepreneurial background of founders, which I think are very valuable and I think can point you maybe directionally. But you need to be making tons and tons of bets, and most firms don't have the capital to actually generate long-term alpha on a strategy of that approach. Then on the flip side, you've got some sort of more growth stage investors that are using some data to make their decisions. Though most VC investors use data in a confirmatory perspective, so they'll fall in love with a company, then get data and hope to God it meets their heuristics inside. Whereas we're saying, no, that's absolutely the wrong way to approach it. Let's remove emotion from this equation. Let's use data to identify those companies that are even worth having a conversation with. So our tool is really meant to screen and focus on the top companies. So I think that right now we're not aware of anyone that sort of leaned into this systematic data-driven strategy in the growth equity market.
Okay, great. And then just another question that came through. One of our listeners is wondering if you're able to share your back test results. So either if you want to speak to it here, or if it's something that you provide to your LPs.
Yeah, happy to provide a slide on that. We've got a slide in one of our core decks here. So, historically it's returned in the mid 30% net IRR going back to 2005, and that's net of all fees and expenses, 2 and 20 fee load applied. We've also layered in excess NASDAQ volatility to that back test to ensure that we're not sort of, not having those drawdowns during negative periods in the public market, as there obviously is often impacts to the private sphere. They're just not always represented in VC funding rounds. Happy to share those results. They've been quite extraordinary.
Okay, great. And I think to John's point, would encourage all of our listeners to, get in touch with the EQUIAM team after this roadshow event as well, to be able to see a lot of these back tests and great content that the EQUIAM team has put out. Just another question I want to address as well is, right now in the venture space, in early stage companies, there's a lot of concern about elevated valuations. So, kind of based on your data-driven approach, what does the data say about, where the most compelling pockets of value are in the venture space?
Yeah, so, I think one of the things we've looked at is obviously enterprise value to revenue multiples, which tend to be the most easily sort of analyzable metric in the private sphere, because a lot of these companies aren't profitable yet. But that EV to rev dynamic, what you see is that the market sort of reacts relatively quickly, especially when you've got public sell-offs. And so, the private market suffers from a stale data problem. So when you look back over the last year, it's going to look like that there's extraordinary elevation, that EV to rev multiple. And that's probably correct, because if you raised around in July of 2021, VCs were happy to pay 45x, trailing 12-month revenue, which was extraordinary. And unless you're growing 300%, that really doesn't make sense. And a lot of those firms weren't. And so one of the things we're looking at is obviously that EV to rev to growth metric, so sort of normalizing it for growth, which helps us to stay focused on firms that have the requisite sort of financial elements to make a multiple of that magnitude make sense. Now, we're never going to be touching a company that's got a 45x, EV to rev multiple. That's just simply not how our model works, what we're trying to do. However, what we have seen though is that as markets sort of decline, VC rounds that have closed in the last 30 days, we're seeing those multiples compress rapidly. And so, it's a very interesting kind of dynamic there where, and this is sort of an EQUIAM observed sort of phenomenon that, when you're in frothy market periods, you want to be investing in companies that, are 6 to 9 months removed from the last venture funding round because that was probably raised at a lower multiple. When you're in, when you're in sort of declining environments like now, you want to be investing in companies that raised the VC round yesterday because that's going to be priced more fairly. And so there's really a lot of these dynamics that we've kind of observed in this market that we're going to continue to lean into as we build and construct a portfolio. So there's certainly ways to take advantage of that. I haven't dug into all of the proprietary juice, but there's some unique things we're seeing. I think that generally speaking, we obviously saw unique overvaluation, or maybe not overvaluation, is sort of on par with where the public markets were last year. And we're seeing the same thing where private markets are deeply correlated with public markets. I think the lag effect is dramatically overstated. There's not really a lag effect. It's more so a stale data problem. The lag is no more than 4 to 6 weeks.
Great. Just another question I'd like to get to, if I may. So, we spoke about how EQUIAM, the typical companies you invest in, they're Series B plus or Series C or beyond, right? So, by kind of excluding the very early stage, startup companies, are you potentially missing out on the biggest winners of tomorrow?
Yeah, that's a great question. I mean, there's certainly going to be some upside cap on our return profile. We're probably never going to have a 1,000x return, but uniquely in Fund 1, we had multiple 9, 7, 8x returns. So if beyond even what we initially modeled out, we assumed that the average return profile would be 3 to 5x on a winning position with a handful of losing positions. Ultimately, it proved to be much higher upside than we initially even anticipated. So, what we're looking at right now is investing in a cohort of companies in the 500 million to 2 billion subset. We anticipate that most of these companies are going to be, doubling to tripling in value over the next 18 to 36 months is, based upon our purview and the way that we analyze companies. But we do know that there's going to be a couple companies within our portfolio that 20x, or 30x because of the nature of, the growth of the private sphere, the growth of technology, and sort of these mutually amplifying effects that are happening in the space. So, we do think that there is obviously the potential for more upside in the earlier stage of the space, but there's also that dramatic outsized risk of failure, where in an early stage portfolio of seed and Series A companies, you may have an 80% failure rate, whereas in our portfolio, our failure rate is closer to 25%. Not failure rate, let's be clear. This is just marked beneath our entry point. No company we've invested in has gone bankrupt, which is obviously a unique element of obviously the growth equity space. But I think even over this duration, we would have expected at least one to happen, and that has not occurred. So certainly something that we like about the sort of later stage market, especially if we're tilting the odds in our favor of companies that are growing exponentially and have those IPO ambitions over the next 2 to 4 years.
Excellent. Great. And on that note, unfortunately, that's all the time we're going to have today for our roadshow. So for all of our listeners, you've been listening to a quantitative approach to VC. How can it deliver big returns in half the time? So first of all, I'd like to thank our presenters, Kirk and John. Many thanks for your time and for your insights about this non-traditional approach to VC investing. And, many thanks as well to all of our guests who, took the time to dial in today, who pitched in with their questions to the discussion today. Just to close off, I'd like to remind everyone that here at Palico, our mission is to bring LPs access to promising top-notch fund managers. And it's in that spirit that we encourage all of the LPs, certainly the ones, who've been listening today, to continue the dialogue with Kirk, John, and the entire EQUIAM team, using our on-platform messaging and video call functions. So stay tuned as well for, many more digital roadshows to come on the most topical themes in the private markets. We hope to see everyone there. Well, thanks again. Thank you, John and Kirk, for your time today. And, until next time, take care.
Thanks guys.
Lucas.
Everyone.